All right, guys, before I get started, please do look at my disclosure statement. Please understand that I am not an investment advisor. Anything that I do show you today is for educational purposes. So if you decide to take upon anything that I am showing you today, please do consult with your own financial advisor so they can help you to understand the relevant risk factors when trading the markets. Thank you. All right, guys, so probably watching this video on Patreon, but if you're not and you want to become one of my members on Patreon, it is free. You don't have to pay for anything at this point. It's going to be patreon.com/chaostrader63. Patreon.com/chaostrader63, just as you see written there. All right. So what I'm going to talk about today, basically, I used to trade this Top Step account that I have. This is a live funded account that I have with Top Step. The thing that you have to do with Top Step is first you got to qualify. I qualified, so then now you have to have 5 winning days of 200 plus profit for 5 winning days. It doesn't have to be in a row, but I've traded for 4 days so far. So I've had 4 completed days and 100% winning days of 200 plus. And basically you can see here my high profit target for the past 4 days is 850. Currently sitting at 850. And I do not have a low because I didn't have a day where I took any losses less than $200. So for the week I made $850. Now we're talking about looking at a $50,000 funded account. When you get a $50,000 funded account, you're not getting $50,000 profit or money or capital. Basically, you're getting what that drawdown is. So if that drawdown is $2,000, you're getting a $2,000 account. If you're going to trade minis with the $2,000 account, you're really gambling. So you could see I'm trading micros with this, and that's why I'm only at 850 right now. And another reason I'm at 850 is because I have a strategy when I'm trading them. So with Top Step, if I get that 5 winning days, once I hit the 5th winning day, I can now start requesting profit, 50% of the profit. So let's say after the 5th day, I have $1,000. I can now request $500 of that $1,000. So what my strategy is first to get the 5 days total. Once I get those 5 days, I'll try to make more money. So what I've done is every day I hit 200, I close out the account, don't trade it anymore until the next day. Once I hit the 5 days, then I'm going to start trading it, and then I'm going to trade it more actively. So therefore I can make more than $200 in that day. All right. But I didn't want to get to 200, take a loss and be back and forth and so forth. So therefore I wanted to play a smart game where I'm just getting my 5 days in. After 30 days, I can take full profit. Okay. So we're trading it smart. We want to be smart in how we trade. And that's why I'm going to introduce you a strategy that's going to help you. You can trade this strategy. I think it'll help you pretty much with what you do. But before I get started with that, I always like to give you a word that comes from the Lord. And today we're going to be talking about 1 Peter chapter 5, verses 8 through 9. What it says is, be alert and of sober mind. Your enemy, the devil, prowls around like a roaring lion, looking for someone to devour. Resist him, standing firm in the faith, because you know that the family of believers throughout the world is undergoing the same kind of sufferings. Again, that's 1 Peter chapter 8, verses 8 through 9. And again, lions attack weak, sick, young, or straggling animals. So they choose victims who are alone or not alert. Much like lions, Satan attacks the weak, the sick, the straggling person, the lonely person. Peter warns us to watch out for Satan when we are suffering and being persecuted, because when we are feeling alone, weak, and helpless, and feeling cut off from God, we're focused more on our troubles than we are of the danger around us, and therefore we're vulnerable to Satan's attacks. So during time of suffering, we need to be strong. In order to be strong, you need to pray. You need to read your word. You need to be fasting. Continue to seek God and continue praying. Keep your eyes on Christ. Stand firm in your faith and resist the devil's attacks. And eventually he will flee from you. God bless you, my brothers and sisters. Hope that helps somebody today. All right, guys. So that trap that we've been talking about, that I've been hiding from you for the last couple minutes here, is the 3/8 trap. So the 3/8 trap trading strategy, it's a technical analysis approach used by traders to identify potential trend reversals or continuations. It primarily involves the interaction of two key moving averages, the 3-period EMA and the 8-period EMA. It focuses on identifying potential continuation points in a trending market after a price pullback. So how does it work? Trend identification. So the strategy starts with identifying an existing trend, typically observing the relationship between the 3 EMA and the 8 EMA. So in an uptrend, the 3 EMA will be above the 8 EMA, and in a downtrend, the 3 EMA will be below the 8 EMA. So you can color your EMAs so you know what's what and where they are. So the pullback observation. The trap element comes into play when the price pulls back against the trend. So for example, in an uptrend, the price may pull back towards the 8 EMA, leading some traders to believe the trend might be reversing. This is where that trap comes in. So in a downtrend, the price may retrace upwards towards the 8 EMA. The strategy anticipates that the pullback is temporary and that the price will resume the original trend. Traders who see the price moving against them, they assume that the trend is reversing. If they enter a trade based on this assumption, they could be trapped, and that's where this trap comes in. So when the trend resumes the original direction, these traders are trapped. Traders watch for the price to stabilize or reverse at or near that 8 EMA, signaling a continuation of the trend. This is where the trap occurs. So the traders who bet against the trend during the pullback are trapped when the trend resumes. And we look for volume to get us into that trade. So the strategy capitalizes on these situations where the pullback lures some traders into making incorrect decisions, while those who follow the 3/8 trap strategy anticipate the continuation of the trend. So entry points. In a bullish setup, traders enter the long position when price begins to rise again after pulling back to or near that 8 EMA. So in a bearish setup, traders enter a short position when the price starts to fall again after retracing to or near that 8 EMA. So the setup. This is a very short-term moving average, which is your 3 EMA, and it reacts quickly to price. The 8 EMA is a little longer than the 3 and provides a more smooth perspective on the price trend. So the 3/8 trap condition, the strategy looks for a scenario where the 3 crosses above the 8. And this signals a potential bullish trend. So once we cross above that 8 with the 3, that's a bullish trend. If the price then pulls back, but the 3 EMA remains above the 8 EMA, this pullback is considered a trap because it lures some traders into thinking that the trend is reversing. Therefore, they take the short position. However, the pullback often finds support at or near that 8 EMA, and this is where we are getting into the trade. All right, we are going to be going long while those trap traders are short and they are in trouble. So the 3/8 bear condition. The 3 EMA crosses below the 8 EMA, indicating a possible bearish trend. If the price retraces upwards, but the 3 EMA stays below the 8 EMA, this retracement can be seen as a trap because the traders are expecting a bullish reversal. The price finds support, or rather resistance, at or near the 8 EMA, leading to a continuation of that bearish trend. And the market goes down and those traders are trapped and we are in our trade. All right, so there we go. Just take a look at this. I'm not going to read through every slide. We want to make sure that you understand how, and I'll show you better on the slides. The risk management aspect. We need to understand the risk management, and I'm going to talk about your risk management as I show you on the slides because this has a built-in risk management factor to it. So I'll be able to show that to you. This 3/8 trap strategy was basically started and associated with Stephen Bigelow. All right, so he's the candlestick person, understands he's the person who not really, I think he may have been the one who did invent candlesticks here, bring them to the, Western world. But also another trader that I understand and know much better is Rick Sadler. And He's associated with the 3-8 trap strategy, uses it in his community, and so forth. So that's where I understood the 3-8 trap strategy from. Let's look at this strategy. So when we're looking at the chart, we're just looking at the chart, no price. We want to see what that looks like. So this blue line here is the 3. And this one is your 8. And then what we're looking for is once we get that crossover here, that signifies a downtrend. We're looking for that 3 to come back towards that 8 right here. And then for it to continue back to the downside. That signifies this is where we're going to get into the trade short. Maybe we take this short candle here, stop loss slightly above, and the market gives us good profit. All right, so that's what we're going to be looking for as we trade this strategy. So you can see again with nothing on the chart, basically the same things. This is where we see the traps develop, wherever we get these pullback areas. So you can see the 3 pulled back to the 8 here, pulled back to the 8 here. It crossed the 8 here. We're going to talk about that. It pulled back here, and it kind of pulled back right there. So those will be our areas. So first of all, it crossed down, letting us know that the direction was bearish. So now we wait. We don't do anything in this area because nothing really happened to give us our opportunity. But then when the market pulled back here, this is where we start to get excited. And then once it starts back down, that's where we get into the trade. We would be looking at volume. So therefore, we would be looking at this bear volume to get into the trade right here, and the market drops to the downside. That's how we trade this, and that's what I'm looking for as I'm trading this strategy. So you can see again, here's the candles. Here's what it looks like without the candles, and if we add the candles, you could see those in areas where we pulled right back to. And then once we get to those areas where we pulled back to, I'm looking to enter the trade bearish on that volume bar right there. So that signifies where I would enter the market. Another opportunity here, signifying where I would enter the market right there. Another opportunity here, signifying where I would enter the market there. And this candle here. But I would not take this trade because the candle is much too big. Big candles cause issues because sometimes big candles aren't what they appear to be. Big candle, this bearish big candle, what you would think was going to be a very good move to the downside. But in actuality there's a lot of profit taking going on. Yes, it did move down a little lower. Sometimes it doesn't even move that far down. So it could have given you some profit, but the risk to me is not worth the reward. The candle was probably bigger than the reward that you would have gotten back. So therefore, I don't trade the big candles because I find that they oftentimes are misleading. Okay? And you don't get what you think you're getting with those candles. So here again, we're looking at the chart with nothing on it. When we add our candles, you could see what happened. So with the chart with nothing on it, again, we had the market crossover right here, where the 3 crossed over the 8. This is bullish, a bullish sign, and it lets us know that the market's moving to the upside. Therefore, we're going to look for long trades when we see that 3 pull back to that 8, and it does it so right there. It kind of did here. Probably could have thought about that, but for sure here. All right, and then once that took place, we got into profit, and then again the market changed direction, let us know we were bearish here, and at that point we will wait for the market to pull back towards that 8. There it did, and then it gives us an opportunity to short again. Other than that, you're waiting. You don't do anything. You wait for the chart to set up, wait for price to set up this setup for you, because basically it's just a continuation pattern where the market takes a little pause and rests, and during that rest is where we want to find an opportunity to get on to the trend, with the trend of the market where it's going in the proper direction. All right, we don't want to go against that trend. We want to go with that trend. And you can see what happened here. So had you taken this trade, you would have got in here on this volume bar, and you could see what happened. Again, you would have taken this trade. Actually, this is where the market corrected itself, changed itself into a bearish market, and then we had the little correction here. Then we would have got in. Now, again, a big bearish candle. I wouldn't have got into the market at that point. And then again, you could see here where we are. Another opportunities. The market, again, what it showed you was that first circle here. This is where we had that 3-8 crossover. So the 3 crossed above the 8, lets us know that we're bullish. We're looking for a correction back to this area, and it did. Therefore, we get in right here. Could put our stop loss here or on the stop loss that's provided by the 17 EMA. That's all that is a 17 EMA with made it into dotted lines. This is actually a slight pullback here. Might have thought about that one and getting into the market here. But this could have been a nice one here because the price pulled inside between the 3 and the 8 and then broke outside the 3 and 8 right here. Could have taken that trade there, but really was a really good trade. The one that we talked about, the 2 that we talked about. Then the market changed its directions right here and went to the downside. All right, so those are the things we want to be looking for when we're trying to trade this strategy. Very simple. If you just follow the rules, you'll be okay. And so now we have, again, market showing you a crossover here. 3 goes above the 8. Then we have a pullback right here. The market pulls back to the 8 area here, pulls back to that same area here, and again here before finally crossing over and going back to the downside. And you can see what the market showed us here on each opportunity. Each one of these, maybe this one would have been a loser right here, but this would have been a profitable trade here. This could have been a loser depending on where your stop loss was, and it looked like it would have been maybe. You can trail it up with the 17 EMA and maybe you would have been safe. Looks like you would have still got stopped out. You would have taken this trade here, and then you would have got into the market right there. This would have been our signal entry right here, and then you made profit. So again, showing you pullback, pullback, pullback. So once we get that 3-8 crossover, look for the pullback, the pullback, the pullback, and take those trades. You could see each trade worked out pretty well. So again, this is a bearish market. You could see we had our 3-8 crossover here. So the green line is the 3 crossed over the 8 to the downside. So once that green is under that red, I know I'm bearish and I'm going to be looking for bearish trades. I'm going to look for the market to pull back. And in this case, it pulls back right here. Pulls back right here where we got the circle. Another pullback right here. And then what happens is we already were getting bearish volume right here. And we get more bearish volume confirmation. And this was right here. And we take that short trade. Again, we already were getting bearish volume here. We get another bearish bar. We're in the trade right there. Sometime you could have taken this trade because it didn't close outside. You want to make sure that bearish volume that you're getting is confirmed. And then you can continue with that downside move. All right, so here we go. I told you I don't like to take trades with big volume and big volume bars. All right, so this is what we're looking at. We got the crossover, and now we're bearish because the 3 is the green one below the red one, which is your 8. But then we get the pullback right here. And then we get big bear volume to the downside. And a huge big candle, the biggest one of all so far up until that point. So therefore, I don't take that trade because a lot of times, like I said, this represents not what you want it to represent. This can represent profit taken, all right? And therefore, yeah, you're going to get some bears looking like it's a bearish market as you get profit taken, absorption, and so forth. So that could be fooling us. And in this case, it kind of did. And then the market moved up with a stop and stopped you out. So therefore, I don't take these big volume bars. I never take them. Plus, my risk is increased because if I'm getting in way down here, my stop loss is way up in here. I have a lot of distance to go to make that up. So there's no need to take that kind of a trade. Be patient. Wait for another trade to come back that suits your needs much better than that one. That one wouldn't have been a good trade. Wouldn't have taken it myself. So let me show you a couple trades that I did take, why I took them and what took place. Here's where I entered, and here's where I exited. And here's the reason I entered. You could see that this green is above the red, which is the 3 above the 8, and it pulled back right here. Pulled back. It was already trending up. and then it pulled back right here. Give me a rejection candle right here. So I could have entered at the top here, but I always like to wait for the candle to close. So I'm in here, at least stop loss there, and then you could see the market moved higher, corrected again, and then pushed higher. This correction was another opportunity to go long, possibly here at the latest. All right, but you could see where my profit was and where I took my ended my trade there with profit by following the rules of the trade strategy. Again, I took another trade. Now this trade I got out really quickly. Reason I got out of this trade is because we did have the 3-8 crossover and then it came back up. I took the trade anyway because for me, this 3, what a lot of these 3-8 trap traders teach, especially like when I'm listening to Rick Sadler, he also says that when that 3 goes below the 8, then you wait again for it to cross over and then correct again and then come back up. Well, that doesn't go low enough for me. So if it doesn't go past the stop loss point, which is the 17 EMA, then I continue with the process of going in direction that the market was going, which is bullish. So therefore I take the trade here, and that's what I did. I actually entered the trade. I didn't enter it here. I waited for this candle to close and then I entered, and then I got out quickly because we ran up to this resistance point. Had I held, I would have made a lot more profit. All right, so you could see where that one went. And then I took another trade right here, entered that trade actually here. It's showing on this candle, but soon as this candle closed, I didn't enter the market. I waited because this was a little big for me, and what happened was it pulled all the way back here, and somewhere in here I entered before it went back down. All right, because I eliminate my risk by that pulling back up a little bit, and I get it much higher instead of much lower, because now I'm closer to my stop loss level, and then I have more profit to gain. And in this case, it came all the way down here. You can see where I took my profit. So that was a profitable trade. It was all set up. Let me show you exactly why it was set up like that. Because first of all, where we got the 3 crossing below the 8, that signaled bearish market, right? Our bearish move. So it went farther and expanded, but then it retraced back. And it never went back above the 8. So therefore I look for the short right here, and I got it. Now in this area, the market was flat. So we really didn't have to do anything. As long as we waited, we could see the separation between the 3 and 8. We knew that there was a trend developed now. And then once we got the correction, we get into the trade, and you could see what happened. We made profit on the trade. Here's a trade that I took that I lost, and it's because I didn't listen to what the strategy was telling me. I decided to do my own thing. Reason being is because, first of all, we did get the crossover. So the 3 was above the 8. That's telling me long. The 3 never went below the 8. So why would you go short, right? Well, that's what you would think. Instead, I looked at this as a resistance point. We held here, and then we broke resistance and started to move to the downside. So therefore, I took a trade on this bar here, and I got out on this bar because I realized I went against my strategy. I also was not right with what I was thinking. I tried to anticipate things. So those are not healthy trade qualities. You don't want to do those types of things. You want to stick with the strategy, follow the strategy, and if you lose on the strategy, at least you're doing what you were supposed to be doing. Now I take a loss and say I could have won if I would have traded right, because what actually happened was, had I traded this the proper way, this would have corrected like it's doing, stopped here, and then I could have entered here and I would have made profit here. But I didn't follow the strategy, tried to develop my own thing, and thought I was smarter than the market, and that's what happens. Follow your strategy. All right, so we could also incorporate a few other things. So we can do this with additional EMAs. So in this case, I have the 3, 8, 12, 16, 20, and 24. So multiples of 4 basically we're doing almost. So from the 3 to the 8, but then from the 8 I have multiples of 4. So 8, 12, 16, 20, and 24, right? So we can do that. This would almost be like the reason I do like it like this is a couple things. First of all, we talk about that 3 going below the 8. Well, in this case, it would have went below the 8, and you could see it did go below the 8 because this pink one here is the 8, and this blue one here is the 3. So the 3 went well below it. Not well below, but it went below it enough to make people say, well, I'm not going to take that trade. I don't want that to happen. I want to make sure that I can still give some room and still take the proper trade. So because the 3 dropped lower, I used this last 24 as the level. It did go a little lower than the 24, but you could see immediately it came right back up. So therefore, I would be looking at taking a trade. Now you could see we still have the 3, 8 right here because 3, 8, and we want to look for that bounce. But if it goes deeper, then we still have the opportunity to pull back to this area and then still go higher. All right. So that's why you can use your 3, 8, 12, 16, 20, and 24 to trade this. And you still would just follow your 3, 8. But if that 3 goes a little deeper, you could still see that it doesn't go much below the 24 and still use that as your target. As your entry. And this, you can also use your 24 now instead of your 17 as your stop loss. All right. So hopefully you understand that. And you can see what happened on the chart. Price pulled way back here, nice and deep. Had a nice entry here, but this is a really good entry because it pulled deep down, then gave us a nice candle. A lot of people aren't looking for this. They're looking for this to keep going to the downside. And therefore, we get profit because the smart traders, the institutional traders and so forth, they know where it's going and we're right on the boat with them. So we can make profit. Again, you can see what it does there. We're still following that 3-8 trap, really. And there it is. You can have a trap with many different types of moving averages. All right. You can do a 920 moving average trap. In this case, we're doing a 3-8 because I believe the 3-8 is faster reacting and gives you a better chance to catch more trades and be on the trend sooner. So if we trade it the way we were looking at, it's much like guppies, right? This is guppies. This is what we were just talking about. This is guppies right here. So this would be the guppies multiple moving average where we have the short-term investors, all right, and then the longer-term investors. So guppy has 2 sets, and the green set is your shorter term traders where we would be looking how we would trade it pretty much, and then your longer term. So guppy gives you an opportunity to pull even much deeper and still continue with that trend to the upside. Now, I don't trade guppies. Used to trade it a little bit. I prefer not to trade as many moving averages on my chart. So therefore, I don't use guppies, but I have used it before. And I do think guppies is a very good trading tool. And we have videos trading it. So volume is an important factor to consider when trading the 3-8 trap strategy, especially when the price pulls back to the 8 EMA. We're going to talk about that volume because I already told you about these big volume bars and so forth. So confirmation of the pullback. Low volume on pullbacks, ideally during a pullback to the 8 EMA on a 3-8 trap. We want to see lower volume. Lower volume during the pullback suggests that the move is not supported by strong selling pressure, indicating that it may be a temporary retracement rather than the beginning of a trend reversal. This increases the likelihood that the original trend will resume after the pullback. We want to get in on that original trend continuation. So high volume on the pullback. If the pullback occurs on high volume, it could indicate stronger selling pressure and might signal a potential reversal rather than just a temporary retracement. So high volume during the pullback could be a warning sign that the market is experiencing significant distribution in a downtrend or accumulation in an uptrend by large players, which could lead to a deeper correction or trend change. So confirmation of the trend resumption. So high volume on bounce. After the price pulls back to the 8 EMA, a bounce off of the 8 EMA on increasing volume is a strong confirmation signal. That is the way that I get into the market. That's the way I'm going to show you how to get into the market. Once you get that bounce off of the 8 EMA, you want to see increasing volume, either to the upside or downside, depending on your direction of trade. So that suggests that buyers are stepping into the market with conviction, supporting the resumption of the trend. And this is what you would look for to confirm that 3/8 trap is working and that the trend is likely to continue. Low volume on the bounce. If the price bounces off that 8 EMA, but on low volume, it might indicate a lack of strong buying pressure or buying interest, raising doubt about the strength of the trend resumption. So the bounce might not be suitable and the trend could struggle to continue. And therefore, you could get caught in a losing trade. So understand that volume when we're getting into it. So the volume, using it as a sentiment gauge. So volume provides insight into the market sentiment and the strength of price movements. In the context of the 3/8 trap, observing how volume behaves during the pullback and subsequent bounce helps traders assess whether the market is still in favor of the prevailing trend or if there's a shift in the sentiment that could lead to a reversal. Detecting a trap, volume anomalies. Analyzing volume can also help identify trap situations. So, for example, if a pullback to the 8 EMA occurs with the low volume followed by a sharp increase in volume as the price begins to bounce, it suggests that the initial pullback was indeed a trap for sellers. Okay, so it lets you know that, yes, that was a trap. So if the pullback occurs with rising volume, it might not be a trap and traders should be cautious. Avoiding false signals. Filtering false breakouts. Volume can help filter out false breakouts or signals. A price move without corresponding volume is less reliable. So in the 3/8 trap strategy, seeing volume align with price movement, low volume on pullbacks and high volume on trend resumption, helps to confirm that the market is behaving as expected and reduces the risk of false signals. So let's look at what we mean when we're talking about trading with the volume. So in order for the market to move higher, you need increasing volume. All right, and this is what we're getting. The market is moving higher and we're getting higher volume, increasing volume. This market could not move higher if this market volume was going down. It wouldn't have the strength and the power to move any higher. That's what you want to see in an increasing market that's moving to the upside. Look for that increasing volume. And in a bearish volume, you also want to see increasing volume, but you want to see increasing bearish volume. The market is decreasing, going to the downside. We don't want the volume to decrease. We want the volume to increase, therefore showing that we have strong selling pressure coming into the market. If we don't have the pressure, we don't have the volume. If we don't have the power, we don't have the volume. If we don't have the fuel, we don't have the volume. We need the volume for fuel, for pressure, for movement. All right. Without it, the market will not move, will not go your direction. So in this situation, we're looking at when the market's trending higher, you look for a correction where the market moves lower on a correction, and then the volume decreases, not increases. So in this case, that's what you see. The market's moving higher in this trend to the upside, but at certain points you see a correction. And during that correction, you see volume drop off. That's what you want to see. You don't want to see increasing volume, because if the volume keeps increasing, the market's going to keep decreasing. It's going to keep going to the downside. We don't want to see that. All right. And then we want to see that nice volume come in for us to take a long. And in this case, I wouldn't take that trade. The candle is way too big. It's much bigger than mostly all the candles on this whole chart. And at that point, I wouldn't take it. And you can see if I didn't take it, I did the right thing, because that would have been a losing trade. So here's a really nice show right here. This shows you what to really look for and how to understand that the market is moving to the downside. And what you're looking for is where the market gets weak for a little bit. It gets weak to the downside. And it also gets weak to the upside. It starts strong to the upside, but gets weak because it's a correction. That's what we want to see. And we want to see that volume drop off. So in this case, if the bullish volume drops off, and then we look for that bearish volume to increase, where we will get into the trade. And you can see the bearish volume increases, meaning that the market could now drop to the downside. Okay? Again, you can see the same thing. Drops to the downside. Only 2 candle retracement, but it shows on both candles that the market volume did drop off. And then finally we get that bear volume coming in. We take that bear volume trade right to the downside. You want to see that bear volume to get you into the trade. You don't need any indicators such as RSI, stochastics, or anything like that to get you into the trade. You only need the volume to get you into the trade. And then you can see where your stop losses would be. You can either put your stop losses in a few places. You can put your stop loss on that 17 EMA that's developed for you, or you could put it at the swing high if it's a little lower than the EMA. All right, because the market, if it's going to go, is not coming back to you. It's going to go. If it's not going to go, it's coming back to you. So no use being way up here because it could still come up there too. All right, so take the small loss and look for a new trade. Again, we see the market moving to the upside. Showed you here where the bear volume is decreasing. All right, and that's what we want to see, because now we want to see an increase in bull volume to continue this trend, and that's the way that we go. Same thing here. You can see all of our entry points. These are all entry points here. So I'm going to mark these where there were opportunities. This is where opportunity was. Opportunity here. Opportunity here. And then you can see we're looking to go to the downside. So we want to see a decreasing bullish volume, but then an increase in bearish volume. A decreasing bullish volume, and then an increasing bearish volume. Decreasing bullish volume as the move goes higher, and then increasing bearish volume. That gets us into the trade, and you can see each time what you had going on. All right, now in this case right here, this volume moved higher, and we had decreasing volume. And that lets us know that the market can't sustain. This one moved higher, decreasing volume. We know this correction cannot sustain itself. That's why we're getting into the trade. Decreasing volume, market can't sustain, we get into the trade. All right, those are all opportunities, and you can see what that volume is letting you know what's taking place. The real traders are not on that market correction. The institutional traders are not with the move to the upside, and therefore the volume is dying off. All right, so what we're looking at here is basically a very good entry where we see the correction taking place, and then we see where the volume is falling off to the downside. This is a bearish move, but the volume's falling off to the downside. And that's what we want to see. We want to see that volume fall off, because now we want to see increasing bull volume to get us into this trade. All right, and that's what we get. And then the market moves to the upside. A very good opportunity. That's what you're going to be looking for when you get into these trades. Right here you could see really the same situation, but you could see where we're going to put our stop losses. You can put your stop loss either at the candle that you enter on, which would be here. You can put your stop loss at the swing low, or you could put it at that 17 EMA, which is the normal setup for the strategy, which is that 17 EMA is the final stop loss for us. Let's talk about how we take profit. Guys, you probably know how we take profit all the time. We're going to use, which is the measured move. So the measured move is a target based on the AB equals CD pattern. It's a concept used to identify potential price targets and trend continuation points. The AB equals CD pattern is a pattern that represents a symmetrical price movement where the two legs are going to be the same. So that's the legs AB equals CD. That's where you get that symmetrical movement. All right, so the key component of the AB equals CD pattern, or the measured move, is the AB leg, which is the first leg of the pattern where the price moves from point A to point B. This move can be either bullish or bearish. All right, and then you get the BC leg. After reaching point B, the price retraces to point C. This retracement is usually a correction or consolidation phase, often retracing a significant portion of the AB move, commonly between 38.2 and 61.8 Fibonacci retracement of that AB. And then your CD leg. Following the retracement point to C, the price resumes its original direction and moves from point C to point D. D is our target level where we're looking to take profit. So the CD leg is expected to be similar in length. Doesn't have to be time. It says length and time, but you're going to see that it's not going to be time all the time. But it does have to be similar in length to the AB leg. So making it an equal move. All right. This is where the concept of the AB CD comes in. And here we go. You can see it right here. So you probably know this if you've been trading with me for a while. But you can see basically this A here. This would be a swing low to the swing high. This would be where we enter at C. And then we're shooting for D. How do we find that? We'll talk about how we can find that and how we look for that target. So first things first, this is the same thing we're looking at right here, the exact same chart, right? What we see is on the chart, we can see the candlesticks that show the swing low. So when we see the swing low, and we're already at this point where we get our correction and pull back to this level, we already know that we have this low here because we're getting ready to enter the market on this volume increase. So therefore we have a swing low here, swing high here, swing low here. So we need to measure and find what we have. So we can use our tool right here, which is going to be your trend-based fib extension tool and trading view. And if you're trading with Top Step, you can use your Top Step X tool, which is going to be the same thing as trading view, exact same thing. And you can find those points because you're going to take that tool, you're going to put it here, and then stop it here, and that'll give you this level right here, where you see that 19355.75. That's going to be our target for D. So when we get into that trade here, we know we can put a stop loss either here, here, or here. And then we know that our target is way up here. That's good profit for us. Good trade. Then you can see the same thing. So this allow you could see the swing lows a little better than swing highs. But again, you could see swing low A right there. Swing low B, swing high B, swing low C. We got that pullback where we look for that 3 to pull back to that 8. We enter the market here. This looks like it might have been some kind of news candle or something. But anyway, we enter the market here. Let's say if it wasn't, we can enter the market there. Put our stop loss below these lows, definitely. And then you can see what the market did. It gave us an opportunity to make profit. But how do we get out? We need to know how to get out. So we need to do that 3/8. We need to do that measured move, right, to get out. So let's see how we figure that out. How we're going to figure that out is basically taking that tool, all right, fixing it to point A, point B, and point C, and it'll give you your target, which is 1 at D, which is 19237.75. Some nice profit again, if you can hold out that long. So for me, I'm going to find that on this trade, I could possibly hold this because there weren't many issues with this one. But I'll show you some that I wouldn't be able to hold. So here's another one. You could see where we have this low, and then we came up to this point here. So this would be swing low A. This would be swing low B. This would be C. And this would be our target right here, D. All right. So I believe, like, when I'm looking at this, the lower point, this would be like, I think I measured this and it was 105 points. So if this is going to be 105 points, then this has to be 105 points. And remember, we talk about time. This developed from here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles. So when we talk about time, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, we're far from that. 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3, 4, 5, 6, 26 to get to that point. Doubled that, right? So the time is not the factor. All right, to me, the time is not the factor. The length is the factor. They need to be the same length. Because you can still get to your point without having the strength that you previously had. Doesn't mean that it's not going to work. All right, so here we go, point A to B. So from point A to point B is 155.25 points. That means when we get into a trade at D, we're going to say D's going to drop 155. Well, not D, at C. Sorry, let's mark this so we don't make any more mistakes. We have A, B. This leg is 155.25 points right here. Then we get our correction. And then the market, we're going to say, is going to drop 155.25 points, which would take us to this level right here. But a couple things happen in the process here. Let's talk about them. First of all, you get this drop and then a move, and we would be expecting to take the trade again because we had a nice touch here. Then we would short here, but in the process, the market does come back on us and stops us out. But in the process, again, it gives us another 3-8 trap right here. And then we could have entered here. So that's where we're going to be looking at our profit. All right, because now when we go back over this, A, B, this is C. This is where we entered the second time. We got stopped out on this first entry, but the high came a little bit higher. So now this would be the point we mark. That's point C, and we shoot for D. So from point C, we're going to say it's going to drop 155.25 points to give us that target right there. And that's where we would get out the trade. So again, we're looking at this point right here, point A, B. So from A to B was 37.75 points. We look to get into the trade at point C after we had the correction here and then a little break above. At this point, we get into the trade. From this point, we would look for a 37.7 point target, which would give us this 19,140, right? Well, as you can see, it moved up, almost touched that level, but then it made a significant drop. This drop, I wouldn't be able to stay in the trade. I would have got out with profit well before that. But if you did hold on to the trade, were able to, you could see that it did take you to your profit target. I don't suggest that you hold on to a trade that is in good profit to come all the way back to zero, negative, or nothing. I'd suggest you take your profit. That's how I trade. I take my profit. I'm not always going to be able to make that measured move one-to-one, and it's not always going to happen either. All right? So I take my profit. So in here we can see another one. Basically, we see point A. I'm going to mark these for you. Point A, point B. How do we figure this out? And point C. because the market went to the downside. And we can do this again. We're using, doesn't matter what moving averages we're using, because we have the 3, 8 plus the multiple other moving averages with the 12, 16, 20, and 24. And in this case, we pull back. This 3 doesn't go above that 24 right here. So we look for that entry, and we're going to enter right here. So when we see A and B, we say from C to D is going to be the same length as A and B. But with my my tool, I can put it on and I can see where my profit target is right there. And that's where I would have taken profit. The market moved right to that level. And that's what you're going to be looking for when you're trading this market. When you're trading this strategy, that's something you're going to be looking for, how to take profit. Also look to your left to find support and resistance levels. Those are going to be areas where you could take profit. And then finally, guys, want to make sure that you're doing the right things because you want to be profitable. I'm going to also tell you a couple other things. But first of all, start growing your account today. Manage your risk. Manage your position sizing, stop loss management, capital allotment. Manage your emotions, the discipline in your execution, okay? Be disciplined in your execution. Avoid overtrading. Stick to your plan and stay focused. Manage your time. Consistent sleep schedule, exercise, study, relax, work out, all that stuff. And then spend time with your family, okay? So your family and friends, they want to have time with you. You want to be able to relax and have time, get away from the charts, clear your mind, and then come back to it another day. Now, guys, I talked about Top Step, and I talked about trading with Top Step and with Apex and so forth. Down in the comment section here, I'm going to post links that you can use to trade with Top Step, to trade with Bullinox, and to trade with Apex if you want to. Those are my affiliate links, and they help me out, guys. So if you decide to trade with one of those companies, please use my links that I'm providing you in the section below. But guys, that's going to be it. Thank you for joining. Thank you for watching. And until next time, guys, have a great one. God bless. So long.